Before trading Bitcoin, you need to read gold and the dollar too. Most traders, when they want to place a trade on Bitcoin, go straight to the Bitcoin chart itself. That is exactly where the first mistake begins. Because many times, before Bitcoin reveals anything on its own chart, the story has already been broadcast through the dollar, bond yields, oil, and gold. If you do not see that chain, you're basically watching the last carriage of the train, not the locomotive pulling it. Gold to Bitcoin. The framework is simple, but professionals take the simplicity seriously. Dollar to yields to oil. First, the dollar. Because the dollar is not just a currency, it is the common language of risk pricing. If the dollar suddenly strengthens, it usually means the market is moving towards liquidity and fear, or it is repricing the path of US rates higher and tighter. Even right now, Federal Reserve comments about persistent inflation pressure driven by the oil shock have made the market more sensitive again to the idea of rates staying elevated for longer. So before any Bitcoin trade, the first thing you need to understand is what phase the dollar is in: a fear phase, a rates phase, or a structural weakness phase. The second step is bond yields. A lot of traders skip this part, even though yields, especially on the 10-year side, often tell you whether smart money is leaning towards growth or defense. When yields move higher, especially because of inflation concerns or the idea of rates staying high for longer, assets that depend on liquidity and risk appetite find it harder to breathe. That is why sometimes Bitcoin doesn't rally the way you expect, even on good news, because the rates market has not allowed it yet. Even in the reports from these past few days, you can see that the combination of higher oil and sticky inflation has revived the whole discussion of keeping rates elevated. The third step is oil. This is where many people think oil only matters for energy. It does not. In this phase of the market, oil is a transmission channel that puts pressure on everything. If oil is rising, it does not just mean gasoline is getting more expensive. It means the market is repricing inflation, growth, and monetary policy. Right now, with Middle East tensions, disruptions around Hormuz, and sharp moves in physical oil and Brent prices, that exact pressure has been transmitted through the system: higher oil, higher inflation, more fragile growth, and as a result, a tougher environment for risk assets. So if you are not reading oil before trading Bitcoin, then you are missing a part of the market's main engine. Then we get to gold. Here, gold is not just a separate market from Bitcoin, it is an important filter. If gold is rising because the dollar is weakening and yields are softening, that can also create a better backdrop for Bitcoin. But if gold is rising only because of geopolitical fear while the dollar is still strong and the yields are still high, then the message for Bitcoin becomes very different. Even right now, Reuters has reported that gold has been supported by a softer dollar and lower yields. That means gold has not moved higher on war headlines alone. The market is helping it through the dollar and bond channels at the same time. That difference matters a lot when you are trading Bitcoin. And at the end of the chain, Bitcoin itself. The common mistake here is that traders think Bitcoin is always a risk asset or always a replacement for gold. But in practice, depending on where the pressure is coming from, Bitcoin's role changes. If the market is in a phase of tight liquidity and high rates, Bitcoin behaves more like a risk asset. If the market is in a phase of structural distrust in money and a weaker dollar, then Bitcoin can take on a very different narrative. So before you hit buy or sell, the right question is not, where is Bitcoin going? The right question is, in this chain right now, which link is dragging the others? Once you know that answer, only then does the Bitcoin chart start to make real sense. Conclusion. If I had to put it very simply, before trading Bitcoin, you should read the sequence in this order. First, the dollar, because it reveals the broader direction of risk and liquidity. Then bond yields, because they show you what smart money is doing with rates. Then oil, because it injects inflation shock and growth pressure into the system. Then gold, because it tells you whether the market is looking for a safe haven or pricing weakness in money itself. And only then Bitcoin. Anyone who starts from the end of this chain usually realizes too late what story market is actually pricing in. Now, if you had to check only one of these 4 windows before trading Bitcoin, which one would you choose first? The dollar, yields, oil, or gold? Write that one in the comments.